Hey guys, welcome back to another video. If you're new to this channel, hi, my name is Miranda and I teach about anything and everything related to the trucking industry and how to navigate it. So if this is a topic that interests you, feel free to subscribe down below. Well guys, I hope you're all doing well and managing to keep your head above water. I know times are not easy right now, but I do believe, I have hope, that there is going to be a mini reprieve in the next couple of months. So since all of us are currently in a less than desirable market situation, I think it's extremely important to start measuring the current health of your business, the financial health of your trucking business, if you will. So today we're going to be looking at how to do that so you can be better prepared and form a strategy that you can use in the near future. Ready? Let's go! No matter the size of your trucking company or whether you're a carrier with your own MC and DOT number or an owner-operator who is operating under another carrier's authority, it is crucial to know your key performance indicators or KPIs. Now, one of the most important KPIs to know is the cost per mile, but this is a topic that I have talked about over and over again. And I actually have a free calculator on my website just in case anyone is interested in finding out their cost per mile. Today, we're going to be focusing on other KPIs, and I actually will be showing you our KPIs for both of our companies so you can see how it looks. So the first KPI is ALOHA.
We're going to Hawaii.
Yeah, I wish. We are not going to Hawaii, unfortunately, but what we are going to do is we will measure the average length of haul. Now, why is this important? Well, because in good markets, carriers tend to reduce the number of miles they do per load. When the market is weak, on the other hand, carriers start looking outside their preferred markets and their preferred lanes, and so the average length of haul increases. So the formula to actually measure ALOHA is the total miles divided by the total number of loads. Pretty simple. So let's take a look at our performance. ALOHA, welcome to 2022. So what you can see here is the blue is our reefer company, which is our original company, and the red is our dry van company. So you can see that in general, the miles have been increasing per load. As of September, you can see that for the reefer, it's around 1,275 miles on average. For the dry van, it's just about 1,000 miles on average. So why are the miles per load increasing in general? Well, it's relatively simple. First of all, deadhead miles have increased. And the second thing is running shorter loads, unless you're somewhere in the Midwest, will mean that you're either getting a really bad rate or you're going to a really bad market. So basically what we have been doing is we have been chasing the market over the last couple of months. And you can see this is why the average length of haul has increased. Then there is percent empty. It is crucial to know the percentage of your empty miles, those deadhead miles. Empty miles cost money because when you are deadheading to pick up a load, you're still burning fuel. And as we all know, fuel ain't cheap right now. So the formula is a two-step formula to make it simpler. Number one, you have to figure out your empty miles for the period, which is total miles minus total loaded miles. And then the step two, to actually calculate the percentage of empty miles, you take the empty miles that you got in step one, divided by the total miles and multiply it by 100. So let's take a look at our performance. As a reminder, blue is our reefer company, red is our dry van company. Let me make this a little bit bigger. There we go. So the first thing I want to point out, because I know there will be questions, is why were our empty miles, the percentage of empty, so high in January when the market was still good? If you guys have been watching this channel from the beginning, you know that about a year ago and in January, we were doing crazy deadheads. And I'm talking about 400 plus miles from Colorado to Utah. This is because loads to Colorado paid so much that they covered the deadhead back to Utah, which was a great place for loads, 3 times over. Now, as you can see, for the dry van company or the baby company, February and March have been pretty bad deadhead months. In February, the deadhead for the dry van company made up 16% of the total miles. For the reefer, It was pretty bad in July, where the deadhead made almost 13% of the total miles. So to understand why this percent empty is so important, let's take a look at the next KPI. So now that we know our empty mile percentage, we really want to know how much are we spending on that fuel used for those deadhead miles. The formula for this is you get your percentage of empty miles and then you multiply it by the total fuel cost for that particular period. Now you can average it, but in my chart, I actually took real costs. So let's take a look how much we're spending on fuel for those empty miles. Well, it ain't good. As you can see, this is $1,100 here. So in February, for the dry van, we spent close to $1,100 on fuel that was used for empty miles. In July, we also spent for the reefer in July and August close to $1,100 on fuel for empty miles. This is why it is so important to have some form of control over how many empty miles you are running in such a fragile market. Finally, there's the operating ratio, which measures the expenses to total revenue. How much of your gross revenue is going towards expenses? The formula is your operating cost, your expenses for a given time period, over the operating revenue for that period, the gross income, and then you multiply it by 100 to get the percentage. So let's take a look at ours. So right away you can see that for our baby company, the operating ratio has been growing, then it went down a little bit, and then it's growing again right here. So that means that in January, for example, for the dry van, about 32% of the revenue went towards expenses. In March, it was closer to 50%. So the main thing you want to remember is that you want to keep this operating ratio as low as possible, because that means you're getting more net income. So what is going on with our original company? Well, in April, you guys know it's at 120% here. That means that our expenses actually exceeded our revenue. April was the only time where we made nothing. We lost money. But why did it make such a huge jump here? Well, this is because starting from February, we started hiring team members. And of course, with team members comes payroll, so the expenses grow. Now, this also means that the revenue does not match the expenses as it did, for example, in January. Of course it doesn't. The fuel prices increased, plus higher team members will usually do less loads during the month because they need time off, obviously. They're not going to run non-stop. So that is why our operating ratio started increasing, but you can see that in August, actually, it decreased, which is an awesome sign. In September, it increased a little bit, but I hope it continues decreasing. But to summarize, the best way to interpret the operating ratio is to compare it over a period of time. If you see that your operating ratio is decreasing over a period of time, that is great. That means that you're making more net income after expenses. If your operating ratio is increasing over time, that means that your expenses are eating your revenue. Now, another thing I recommend tracking is how early or late brokers pay you. Now, this is a metric you will get over time by keeping track of your pay dates versus due dates for your invoices. And this is essential for managing cash flow, because after a while of tracking the brokers, you will see how much each broker averages, and it will give you the ability to make better decisions when booking your loads. Now, I hope you know that I adore you guys, so I'm actually going to give you a little cheat sheet here. This is a chart I made rating brokers by their payment performance. These are not all brokers that we have worked with, but these are some of the brokers you can encounter. So let me zoom in. This is the average days to pay from our experience. I literally took it from our two companies and I made averages. Of course, Uber and Convoy are awesome. Uber averages 3 days to pay, Convoy averages 4 days to pay. John J. Giroux, great company. Now let's take a look. There's Navajo, Landstar, Giltner. What I'm going to do, because I know it's pretty hard to see, I will leave a link down below so you can check it out, because this will give you very good insight when booking loads. TQL is consistent 28 days, which is awesome. But for example, let's look right here. Ease Logistics Services, even though they have a great credit score, they average almost 50 days to pay. Redwood Logistics is one of my favorite brokers, believe it or not, but they average also around 40 days to pay. Coyote is a broker I have worked with numerous times. They average 40 days to pay. So again, I'm going to leave a link to this down below so that when you're booking loads and you see a load by one of these guys, you can see what their real average days to pay is. Okay, I know this is a ton of stuff to remember, the formulas, what they mean. So I have made everything much easier and I created a free KPI calculator for you guys. I have the link down below. Let's take a look at how to use it. Okay, my friends, so this is the calculator. Let's go over it very quickly. There are instructions up on top. Basically, you will choose a time period for which you're calculating these KPIs. So first you will want to enter the total miles. Let's say you had 12,000 miles in 1 month and you did about 10 loads. So that means your average length of haul, ALOHA right here, is 1,200 miles. This is the average load you're taking. Next, the percent empty. So for this, you will want to re-enter your total miles for this period, 12,000 miles for the month, and how many loaded miles you had for this period. Let's say you had 9,000 miles loaded. That means that 3,000 miles were empty, or 25% of the total miles were empty. Now, in order to get the fuel expense, you will have to calculate what your total fuel cost was for this month, since we're doing a monthly calculation. Let's say your total fuel cost was $8,000. That means that for those empty miles, for that deadhead, you spent $2,000. Finally, for the operating ratio, you will need your total expenses for the time period and the total income for this period. So let's say your expenses were $12,000 total and your income was $20,000. That means that your operating ratio is 60%. 60% of your income is going towards expenses. I do suggest that when you use this calculator, have a running spreadsheet as well where you can record all of your key performance indicators. That way you can then compare them week by week, month by month, quarter by quarter, and year by year. Anyway, I hope you guys enjoyed this video. I hope I provided some insight, and I really hope and encourage you guys to use this free KPI calculator that I created. I will be honest, when I put in our numbers and measured our KPIs, it gave me a ton of information about the performance of both our companies. And now I have a better understanding and some insight on what strategies I can use to optimize our operations going forward. All right, friends, that's it for now. I'll see you all in the next video.